How do import prices cause inflation shocks? Imagine walking into a store and seeing prices jump overnight. That sudden change can often be linked to what countries pay for goods from abroad. When the cost of imported goods rises, it can push prices higher across the economy. This is because imports are part of what we call the basket of goods used to measure inflation, like in the Consumer Price Index. If the price of electronics or clothing from other countries increases, stores may raise their prices to cover higher costs. This quick increase can cause inflation to spike temporarily. But it's not just final goods that matter. When the cost of raw materials and parts imported for manufacturing goes up, it can lead to longer-lasting inflation. Domestic companies face higher production costs, which they often pass on to consumers over time. Think about how a rise in the price of imported steel or computer chips can make everything from cars to appliances more expensive. Trade disruptions, like tariffs or higher shipping costs, also play a role. If shipping costs jump because of fuel prices or supply chain issues, the price of imported goods increases even if the actual product price stays the same. This cost gets passed along to consumers, causing inflation shocks. Currency exchange rates are another factor. When a country's currency loses value compared to others, importing goods becomes more expensive in local currency terms. This means higher prices for imported products and can push inflation higher. Conversely, if the currency gains strength, import prices tend to fall, helping to slow inflation. Studies show that a 10% increase in import costs can raise inflation by about 0.3 to 0.7 percentage points within a year. The effect is usually stronger and longer-lasting when it comes to intermediate goods like raw materials rather than finished products. Keeping an eye on import and export price indices helps policymakers understand external cost pressures. These indicators are key inflation signals because they show how global factors influence domestic prices. So, in simple terms, when import prices go up because of trade costs, tariffs, currency changes, or supply chain issues, they can cause inflation shocks by making goods more expensive both directly and indirectly. This is why tracking import prices is so important for understanding and managing inflation in any economy.